welcome to the 1021st installment of Short-Term Trading Live with Oscar Carboni, and that would be me. Good evening, traders. This video is being filmed on Monday night for Trading Tuesday, February. You know, I've been messing up the date in almost every video lately. May 14, 2013. Traders, we got a lot on the board, so let me just say this. Let me remind you that futures trading is extremely risky, can cause substantial financial loss. You can lose your shirt, you can lose your pants, you can lose everything you ever had in this business. So if you don't use stops and you don't understand the risks, get up and run. To the rest of you cowboys, rock and roll. Let's get right into this video. Are we ready? Traders, green arrow on the board. You gotta love those green omnis, right? Green, green, green. We always clap for green omnis. Hooray, hooray, hooray. Let's see if that's what we're gonna get. Traders, we've had a lot of up days in a row, and it's getting a little worrisome to throw another green omni up there, but I am not in control of whether that arrow is pointing up or down. That's the Omni. The Omni's pointing up for Trading Tuesday. We are starting off the trading session on the buy the dip side. Now, we have studied this topic many times together at the Omni Trading Academy. I've done many videos about this, but I am here to say this. When in a bull market, we buy the dips until it hurts, and that's it. You don't argue in a bull market. It comes down, you buy the dip, have your stop in, and wait for the rally. Sooner or later, it will hurt, and the day it does, you stop buying the dips for a few days, you let it come off a few days, and right back into buying the dips again. That's what a bull trader does in a bull market. We buy the dips until it hurts. So I am here to say, once again, for the Russell, for the ES, for the NASDAQ, we start this day off on Tuesday by buying dips. Traders, there are F flags flying all over the U.S. indices. I will show you what the F flags are. You know that's an Oscarism. An F flag simply is a formation that ends up filling in something like that. It's got a bunch of bars that go up, and then it gets into a consolidation. Considered an F flag. That F flag usually carries through for a few weeks on end, and you just keep moving higher. So I will show you those F flags. Now, traders, I cannot tell you countless amounts of people in my trading rooms and letters and emails over the last couple of years saying, Oscar, they're printing money like crazy. They're printing money like crazy. What does it mean the Fed's printing this money? It's going to be hyperinflation. It's going to ruin the world. Now we've got Japan printing. You've got Switzerland printing. You've got everybody printing. And traders, it is time for us to talk a little bit about that. So let me explain how this works. In 2008, leading into 2009, the Fed put this huge injection of money into the markets, trillions and trillions of dollars. And at that point, I did an assessment. Traders, this is my 31st year of trading and watching markets, analyzing markets. You know I work my fingers to the bones every day and night, right? So I have followed all the fundamentals. I've followed all the technicals. I've followed everything I can follow. And this is what I've come up with. This has been a theory I have shared with my trading rooms in countless videos. I have held live classes. I've shared this theory about what's going on. This is my theory since 2008 about what should be going on, why we're printing dollars, and what it all means. Traders, printing money today is the equivalent of stockpiling gold during the gold standard. Once we came off the gold standard, we made a big mistake, and I'll explain that to you. What the big mistake was, or the big major step was, we forgot to print the dollars that were needed. What does that mean? The way this is supposed to work, the way it worked while we were on the gold standard was this. The U.S. backed its credit in gold. When it had gold in the bank or in the vault, it issued $1 worth of credit. When it needed to issue another $1 worth of credit, it put another $1 worth of gold in the vault. So if you're going to back credit by gold, and every time you issue $1 worth of credit, which is either a dollar bill or selling a bond or a derivative, if you're going to issue $1 worth of credit, you need to put $1 worth of gold in the vault. We get off the gold standard, and we continue to issue credit, but guess what we decide to back the credit with? Dollars. What do you think the big missing step was? We continued to issue credit and stopped stockpiling the dollars. The way we would stockpile gold, $1 worth of gold for every dollar printed, for every dollar in credit issued, you stockpile gold. Suddenly you get off the gold standard, you continue issuing credit in dollars, but you stop stocking something. You have to stockpile something. If you get off the gold standard and you get on the dollar standard, then stockpile dollars. And my theory has been this all along. There was not enough cash in the system any longer in 2008 and 9 to back the trillions of credit, and the system broke. That's what happened. Now we're printing money and the system's getting back on its feet. Japan is printing money. The system's getting back on its feet. Look around at the countries who can print money right now. Printing money is the equivalent today of mining and stockpiling gold back in the 70s during the gold standard. That's been my theory all along. Now, it may be right, it may be wrong. No one knows for sure because these are unprecedented times and we've never seen what the Fed has done to our markets ever in the past. So no one has a yardstick to look back at and say right or wrong, but I am telling you from my 31 years of experience, and I watch everything going on, the system broke down because we stopped stockpiling whatever we use to back the credit. Turned out to be dollars after the gold standard. We stopped stocking them, and we had trouble. Now we print dollars, we stockpile dollars. The market's doing better. The economy's doing better. Japan is doing better for the same reason. Bravo for stockpiling those dollars. Printing dollars today is good, not bad. Remember that. Traders, let's get back into the meat and potatoes behind trading because my theories are meaningless. I could be some nut with this lunatic in the back of my head spewing theories out that are meaningless, right? So let's go back to what's important, the chart. Chart tells me we have F flags flying, we still have to buy dips, and with no further ado, let's go look at some charts.
Traders, Oscar Carboni is holding another Omni Camp live in Las Vegas. Omni Camp is an intensive 4-day course taught by the Wall Street whiz Oscar Carboni himself. Oscar has been analyzing markets and trading commodities on and off the New York trading pits for over 30 years. Trading for a living is a very difficult business. Oscar will simplify the process so that you can easily understand and analyze the markets. Classes are limited. For more information, call 702-629-4755. Our phones are staffed 24/7. Futures trading is risky and can cause substantial financial loss. Trading futures is not suitable for all accounts.
Traders, the NASDAQ. Here's the daily bar chart on the NASDAQ. And you know what? This chart speaks for itself. Simply divine. We've had a major rally, which was actually a bit of a flat for quite some time, has gone into a beautiful parallel channel to the upside. And look at this F flag flying in the wind. I mean, that's a great F flag. I am not going to consider the downside unless something major happens. This would probably be the spot to go long tomorrow in the NASDAQ if it's going to hold, because you have the bottom of the F flag and the bottom of this trend line getting in at the same spot. I like that spot. Indicators are bullish. Other markets are bullish. Simply divine, if you ask me, is that NASDAQ chart. Traders, the Russell 2000. Russell 2000, F flag. Russell gets above major resistance, goes into this F flag. You can see with these 2 days here, here's your flagpole, right? Made up of this day and that day, so there's your long flagpole. And you go into this parallel channel, or F flag, and that looks fantastic. Traders, if you'd like to call this simply a parallel channel and say, Oscar, your F flags, that's ridiculous. All right, so let's do that. Parallel channel here, parallel channel there. Each time you do go into a parallel channel, you might note that it's longer than this one. Certainly these are both longer than that small one. So if it's not an F flag, if you don't believe in F flags and you just believe in parallel channels, you got a few more inches to go to make it look just like either of the ones in the past. Still bullish, right? Then we look at the E-mini S&P. E-mini S&P, F flags are just flying in the wind all over our U.S. indices. This chart continues to speak for itself. Big parallel channel, goes into an F flag. Here's the flagpole, here's the F flag. Breaks out with another flagpole into a secondary F flag. You can go all the way up here. That is easily in the 1660s. Let's see where it's going to go. You can easily end up there without any trouble at all. And then we look at the weeklies on these charts, traders. Look at how perfect that weekly Russell chart is right now. Big parallel channel. Smaller parallel channel, the blue one. But here's what's interesting. It gets above the parallel channel last week and a little bit this week already, which means it now wants to start heading up to this red line, which you couldn't even see right now on the chart. It's so high. But that's the way it's looking. Now, we know we place stops, and we know markets don't always go straight up, and a stop order will knock us out if we are wrong. But looking at these weekly charts and the dailies, you got to be buying dips in U.S. indices. Then we have the S&P on a weekly. Traders, again, from the all-time 2007 highs to the crash low of 2009, when we started adding all that money I'm talking about, we have this major parallel channel into a secondary parallel channel, blew out past that parallel channel a long time ago. Back here represents previous contract highs back in 2007. We're much further than that. 1680 is the top of this trend. We should easily be able to make it there at some point in our emini S&P. And you got the NASDAQ. Traders, look at how fantastic this NASDAQ looks on the weekly. Long term, look how far back this goes. 2009 lows. This is a perfect market. When it rallies up, comes off, puts in a new high, comes off, puts in a newer high, comes off, puts in a higher high, comes off, puts in a higher high, comes off, and puts in a higher high. Each one of these is higher than the one before it. That is absolutely what you want to see when studying a bull market. Then there's the bonds, traders. I've shown you this chart many times. Remember how this chart came to life. Shoulder, head, we put a fictitious shoulder in here. This had 0 bars, nothing in it at all. But I drew the right shoulder. I said, I think this is a shoulder and a head. So I drew in an empty red circle, and I put these red lines in it. And I said, traders, in my chat room during live classes about a month or so ago, I said, let's see if this starts to fill in. And since I put these red lines in this red circle, we have filled in like this. And now we're starting to come off in bonds. And if I'm right, we're just getting below OTAPMA right now. And once we get below OTAPMA, these red lines should fill in. And that should be the beginning of the end of the big cyclical bull market in bonds. This should be the beginning of the end of the cyclical bull market in bonds. We shall see. We'll play it one day at a time, but that tells me it looks like bonds may finally have played its final rally. Once again, one day at a time. We don't fight the Fed. Whatever the Fed wants to do, it will do, but it is starting to fill in almost exactly as we thought it would. Traders, pull your own charts, do your own homework. Come on down to livewithoscar.com. Come into my free trading rooms and allow me to teach you the art of technical analysis the way I've learned it in the past 31 years. So, traders, you've seen the charts, and there is my technical argument for why we're starting off on Tuesday with the green Omni. Now, traders, as I was talking about with my theory, you must understand that was the problem. There's simply, in 2008 into 2009, there was not enough dollars left in the system to back the trillions in credit we had out there, and the system broke. I think that we are healing. I think we will continue to heal. And I think if you are a country out there in control of printing your own currency without going crazy and overdoing it, printing your currency right now is going to help you get back on your feet. All right, traders, that's the fundamentals. The technicals, as we know, rule the roost here. Technicals tell us that we have a green Omni for trading the S&P. Remember, we have studied this topic many times, traders. When in a bull market, we buy the dips until it hurts. Our stops will be in. We do not trade without stops. So if it hurts tomorrow, all right, so what? Then we'll start looking for downside. I don't know that that will be the case. We'll continue to buy dips till the market tells us otherwise. Traders, remember, if you like the analysis that you see in these videos, if you'd like to join me, come on down to livewithoscar.com. If you'd like to come out to an Omni Camp, and I'm going to clap for Omni Camp. I love my Omni Camps. Omni Camp is a 4-day training session held live here in Las Vegas, live here in a classroom with me for 4 straight days. Omni Camp will be the last weekend of June. There's a few seats open, traders. If you'd like to qualify for one of those Omni Camp seats, come down to livewithoscar.com, click the top right banner on any page. It is an Omni Camp application, Fill out that application and I will personally call you to qualify you. All right, traders, I can't wait to see you at the site in a little while. I'm running right downstairs, going back into my trading rooms, and I think I'll give out a t-shirt tomorrow. Another round of applause for that. Let's do a t-shirt contest for tomorrow. What I would like to do, I'd like to run the contest on you sending in a picture to me, put it in my chart upload, of the most killer trading desk that you have put together. But I don't want you to go on Google and download someone else's. I want to see you sitting at that trading desk. I want to see that it's yours. Whoever sends the coolest picture of them in front of a trading desk for tomorrow wins the t-shirt. I will see you there. Remember, livewithoscar.com. Come to my free trading rooms, and always remember to keep your emotions out of trading. One of the best things you can do to help yourselves with that is say this to yourselves every morning, every afternoon, every evening, and you know what that is. Stops are in. Emotions are out. Rock and roll traders video 1021, and the F flags are flying all over the place. Buy it until it hurts. Futures trading is risky and can cause substantial financial loss. We do not claim or guarantee that you will profit from the information provided.